Guess what held up in this period? Bonds. Interest rates come down. You know what happens to bond prices when interest rates come down? They go up. So if I have a 4% bond yielding me 4% on $1,000, I'm getting $40 of income, and yields fall to 2%, my $1,000 bond, if it's a 10-year bond, will actually go to about $2,000. It'll almost double in value. And look at what bonds did here. And this is the U.S. Treasury bond in the middle, the 10-year Treasury note. And even the 1-year Treasury is up 6%. My dad, you know, he was so conservative, I think he coined the phrase, the only sure way to double your money is to fold it over. And a lot of investors felt that way, and those people that abandoned the stock market and moved to bonds, and particularly short-term treasuries, really did just fine. And corporate bonds on the right side were only down about 4%. So bonds held up. Now, here we are in this economic mess, so how do we get out of it? And it looks in hindsight as if all the quarterbacks around the world got together in a massive huddle and said, this is what we should do. It didn't happen that way, but in hindsight, it looks like everybody agreed to 2 solutions to get us out of this. 2 major solutions to get us out of it. The first one was, we're going to make money unbelievably cheap. We're going to make capital, borrow capital is going to be made very inexpensive. Why? Because we want you to borrow money, we want you to invest, and we want you to spend. Corporations, we want you to borrow. Individuals, we want you to borrow. So the way out of this is to send a very consistent message, as it turned out around the globe, please start borrowing money. This all got accelerated in mid-September, September 18th, when Lehman Brothers collapsed. Now look at how fast we took down interest rates to make money cheap. Unbelievable. And this is the U.S. Fed funds rate, the London interbank borrowing rate, which is the equivalent around the globe to the funds rate, China and Canada. Everybody did it. It's as if everybody in the boat grabbed an oar that said, make money cheap, and started pulling. And the second thing we did was we also said we need to stimulate economies around the globe through government spending. And so the governments began to undertake spending, and in fact, most major governments put into their economy about the same amount that their economy either slowed down or contracted. It's a really amazing thing after the fact to see that. Not sure whether it's just the law of unintended consequences or something more conscious. Here's the United States and China, 2 of the bigger countries, and you can see they spend between 3.5% and 5% of their economic output to back into their economies. China's economy contracted by about 300 billion, and you can see that they basically put that amount back. By the time we're done spending our stimulus, which we're not quite done, we will have spent between $725 and $800 billion of stimulus. And by the way, these weren't the only 2 countries doing it. Every single one of these countries was putting between 4 and 7% of their economic output back into the economy to fill the hole that had been created by the economic recession and the contraction or slowdown in growth that was occurring in the countries depending. So everybody's now in the boat, got an oar that says cheap money and got an oar that says stimulate, and the guy says stroke, and away every country goes, pulling basically in the same direction at the same time with the same objective. And did it work? Boy, did it work. The economy started to recover. These are 2 developed economies, the U.S. and Germany. And you can see they're in negative territory. There's almost our 6% contraction in the U.S. going on. There's a little bit of contraction in the prior quarter, prior to this chart. So there's our contraction. We come off the bottom, start getting positive numbers. Germany's numbers are now pushing 3%. And we get this nice sort of, not, I wouldn't call it exciting stimulating recovery, but it starts to recover. But now, look at what happens in the emerging markets. Holy smokes. Look at those growth rates. Brazil and China are just unbelievable. Let's just take China as an example. It's a $5 trillion economy. You grow your economy just at 10%. That's a huge number. It's a $500 billion growth rate. Everybody with me? Take 10%. Suppose you only get a 3% growth rate in the United States. But we're a $15 trillion economy. We contribute $450 billion to growth. So here's a country that's generating more economic growth, $500 billion, versus the United States. Why? Because it's growing exponentially faster than the United States is growing. So these emerging markets, and this sets the stage for this global growth divide. We've got these regions and countries around the world that are coming out very modestly, and then we have other regions that are going very quickly. And it's going to cause differences. The crew in the boat no longer is grabbing the same 2 oars. They're not all on those same 2 oars. wars. Some countries are still on those same two wars, and others are in different places at different times. So did the stock market get this message? Oh boy. Oh boy, did the stock market get the message. Stocks have a huge jump. Look at this. Emerging market stocks are up 108%, and this is in 9 months. This is from March of 2009, when everybody thought it was Armageddon for capitalism and nothing would survive, and corporate America was going to go under. Emerging markets are up over 100%, and by the way, they tack on another 20% in 2010. So they're up nearly 130% at the bottom. Unbelievable. 50, 60, 70% returns. On March 9th, I was on CNBC, and I was on right before the CFO of a little company called General Electric. Okay? And CNBC can be real nasty if it wants to be. And they were going to attack the CFO because GE stock at that point, that morning, was selling for $5.85 a share. Okay? CFO's on, he's going to be on for 15 minutes, I'm on for 3 minutes. I sit down in the green room to watch his interview, and there's one interviewer, and he's getting really pummeled with questions, the CFO, and he's handling them beautifully. Obviously in command of his subject, knows the company inside and out, and he's answering the questions beautifully. And underneath the interview, while it's going on the screen, they're running the real-time price of GE stock. That's a CNBC for you. Okay? So I'm sitting in the green room watching this guy. He starts the interview, stock's at 585. He's 5 minutes into the interview, 575, 565, 545. It ends at $5.15 a share, down 70 cents on a $5.85 stock. If you'd had the courage to buy GE on March 9th, you'd have quadrupled your money. If you had bought a little company on March 9th called Whole Foods for $7.25, today it's $53. Okay, it's unbelievable opportunities. 80% of investors through the downturn and the upturn did absolutely nothing with their portfolios. So very few people stepped into what turned out to be an opportunity of a generation. So we've had the fall in 2007, we've had this recovery. So we go kind of reverse gear, maybe to neutral. 2010 was a big transition year, and it was very volatile. It was not an easy year. It did get us into positive territory, and it does have a first gear or second gear kind of feel to it. But there were a lot of speed bumps that we went over, and we had plenty of them in the domestic economy. You all know these. I always like to leave you with an important term. The new one is QE, quantitative easing. I call it here monetary easing. It's euphemistic for printing money. Okay, there's a lot of money being printed. The Federal Reserve has carpet-bombed our economy with about $2 trillion of money supply, and that went on. We had the flash crash. Anybody remember what that was? May 6th of 2010, you went to lunch, stocks were down about 80 points by the time you finished ordering your BLT. It was down 650 points. Procter & Gamble had fallen from $40 a share to $1 a share in that period of time because of a computer sort of domino effect that triggered one series of trades after another. It was unbelievable. So of course people were scared about the stock market. We had elections coming. We had taxes and regulation. Those were issues as well. And then globally, you know, we had this tremendous crisis in Europe. So the markets are actually doing okay in 2010, but then we get all these speed bumps along the way. And in the European crisis, I mean, suddenly Greece says we may go under, and you're kind of envisioning you're going to have 3 million pounds of hero sandwiches delivered to your doorstep. You know, it's a very tough period. And other problems around the world. China growing too fast, Japan not growing fast enough or not growing at all. So how do the markets react to these speed bumps? When we came into 2010, early in the year, we were getting great corporate profits. The consumer seemed to be coming back and doing some spending. It seemed to be a pretty good period, and the stock markets really liked it. And the stock markets were up very nicely. This is through about the end of March. Then along comes the middle of the year when we get Greece and Spain and Portugal and Italy and Ireland and a banking crisis in Europe, which is still going on to some degree in all of those situations. And we give up all of those gains in 5 months. By the end of August, everything's in negative territory. Then along comes September, October, November, December. We get great corporate earnings. We get great sales for those corporations. We get tremendous consumer numbers, and companies for the first time start to spend money on capital and equipment. A very important piece of the jigsaw puzzle on market recovery. The elections occur, some of the tax and regulation things start to get talked about, in some cases sorted out, and look how we finished the year. Unbelievable. With all those speed bumps, we end up with a year that I would call sort of regained confidence. and basically look at the returns we have. Emerging markets were up, as I said, another 20%.